If you are still holding your bags right now, patiently waiting for that legendary post-halving, for your cycle mega pump just like in 2021, congratulations. You have officially become Wall Street's favorite exit liquidity. I am going to be brutally honest with you today. The crypto market you fell in love with, the one with the predictable for-year cycles where everyone gets rich just by holding through a bear market, is dead. It has been completely dismantled, repackaged, and sold back to you by the very institutions that used to call it a scam. Today, we are going to expose the terrifying truth about why the for-year cycle has vanished, how the financial giants have entirely rewritten the rules of the game, and what you absolutely must do right now to avoid seeing your portfolio ground into dust. This is not just another market update. This is a survival guide for the new era of institutional crypto, and you cannot afford to ignore this. Remember when crypto was just a rebel's playground, a beautiful, chaotic casino where everyday retail investors actually had an edge? Once upon a time, every 4 years, the Bitcoin halving would cut the supply of new coins in half. Every day, retail investors would slowly accumulate, believing in the sacred geometry of the 4-year chart. And then one day, the supply shock would hit. Because of that, the price would explode, altcoins would go parabolic, and ordinary people were buying Lamborghinis with internet money. And because of that, a narrative was born, the unbreakable 4-year cycle. We all believed that if we just survived the brutal 70 or 80% drawdowns of the bear market, we would inevitably be rewarded with life-changing wealth in the next bull run. It was a simple formula. Buy the blood, wait for the halving, sell the euphoria, and repeat. But, and this is a massive but, that game ended the second the spot ETFs were approved. You see, the retail investor was once the whale in this small pond. Your hype, your stimulus checks, your YouTube searches, they drove the market. But now, you are just a plankton swimming in an ocean controlled by apex predators. The illusion of the good old days is keeping millions of retail investors trapped in a cycle of false hope. You're looking at historical charts from 2016 and 2020, thinking the exact same pattern will play out. Therefore, you hold on to useless altcoins, waiting for an alt season that is mathematically impossible to occur in the way you remember it. The market has matured. And maturity in finance means the big fish eat the little fish with ruthless efficiency. While you were busy drawing shiny triangles on trading charts and fighting over which dog coin is going to the moon, BlackRock, Fidelity, and the traditional finance giants were quietly buying the entire board. They did not just enter the market. They bought the infrastructure. They bought the narrative. They bought the exits. For years, Bitcoin was viewed as a high-risk tech stock on steroids. It was volatile, unpredictable, and easily manipulated by a single tweet from a billionaire. But the institutions looked at this asset class and realized something profound. They realized that Bitcoin is not just digital gold. It is a structural reserve asset. Every day, the spot ETFs are sucking up hundreds of millions, sometimes billions of dollars worth of Bitcoin. They are absorbing the daily mine supply multiple times over. And because of that, the influence of the miners, who used to dictate the supply-side economics of the halving cycle, has been completely neutralized. The halving is no longer a macroeconomic shock. It is just a rounding error on BlackRock's balance sheet. But the plot thickens. You might think that institutional money flowing in means prices should just go up forever, right? Wrong. Institutions do not trade on emotion, and they certainly do not trade on 4-year timelines. They trade in decades. They trade in global macroeconomic liquidity cycles. They use algorithmic trading bots that suppress volatility. They sell covered calls to generate yield on their holdings, effectively capping the upside of the market. They want steady, controlled, annualized returns to offer their pension fund clients. Because of that, the explosive, face-melting volatility that made retail investors rich is actively being engineered out of the system. Therefore, if you are sitting there waiting for Bitcoin to suddenly shoot up 300% in a month, so your mid-cap altcoins can do a 100x, you are playing a game that no longer exists. The institutions have taken the steering wheel, and they are driving the bus exactly where they want it to go, over the cliff of retail expectations. You are playing checkers while they are playing four-dimensional chess with infinite capital. And worse than that, they are using your predictability, your religious faith in the 4-year cycle, against you. They know exactly when you are going to buy out of FOMO, and they know exactly when you will panic sell. You have become the predictable algorithm they are trading against. Let's pause and look at the real numbers, because the data is absolutely terrifying if you are not prepared. In previous cycles, retail trading volume dominated the exchanges. When Bitcoin pumped, it was because millions of individuals were hitting the buy button on Coinbase or Binance. Today, look at the on-chain data. Retail volume is a fraction of what it used to be. The massive green candles you see on the charts are over-the-counter transactions, ETF inflows, and sovereign wealth funds quietly accumulating in the dark. They do not buy green candles, they buy your red candles, they buy your fear. But they do not just buy Bitcoin. That is only step one of their master plan. The real conspiracy, the actual multi-trillion-dollar wealth transfer that is happening right under your nose in 2026 is not about digital gold at all. It is about the complete tokenization of the traditional financial system. They are building a Trojan horse, and they have painted it to look exactly like the crypto revolution you always dreamed of. We are talking about real-world assets, or RWA. While retail is still obsessing over layer-to-meme coins and gaming tokens that have zero actual utility, the central banks, the mega funds, and the private equity vampires are moving trillions of dollars of real estate, government treasuries, and private credit onto the blockchain. You see, the original promise of crypto was to bank the unbanked and bypass the corrupt traditional financial system. But the institutions looked at this technology and said, "Thank you for building the rails. We will take it from here." They are not adopting crypto to set you free. They are adopting the underlying blockchain technology to make their own systems more efficient, more liquid, and more profitable. And because of that, they are creating a tiered market. On one side, you have the institutional tokenization of real, yield-bearing assets. On the other side, you have the retail casino of worthless governance tokens. They want you distracted in the casino while they buy up the entire real world and put it on a ledger they control. Therefore, the old strategy of blindly throwing darts at top 100 altcoins is financial suicide in 2026. The liquidity is not going to trickle down to your favorite forgotten token from the last cycle. It is going to be locked up in institutional grade, compliance-heavy, tokenized assets that you probably do not even have access to yet. The game has been rigged on a fundamental architectural level. Let us talk about exactly how they are doing this. Imagine a massive commercial real estate building in Manhattan. In the old days, only billionaires and massive real estate investment trusts could own that. Today, they tokenize it. But they do not tokenize the equity. They tokenize the mezzanine debt. They package the riskiest part of the capital stack, slap a crypto buzzword on it, offer a supposedly safe 8% yield, and sell it to decentralized finance protocols. When the commercial real estate market crashes, who takes the hit? Not the bank. The smart contract does. The retail liquidity pool gets drained. It is the 2008 subprime mortgage crisis all over again. But this time, it is happening on the blockchain. And there is no government bailout for your decentralized wallet. You are absorbing the systemic shock for the traditional financial system. And because of that, the institutions love crypto now. It is their ultimate trash can for toxic assets. But wait, the manipulation goes even deeper than that. Let us look at the actual mechanics of the exchange-traded funds that everyone celebrated as a massive victory for crypto. When the spot ETFs were approved, retail investors cheered, thinking Wall Street was finally validating their bags. But Wall Street does not validate. It dominates. The spot ETFs are structured as cash creates, not in-kind creations. This is a crucial distinction that most crypto influencers do not even understand. It means the institutions control the exact timing and the exact venue of the buying and selling. They do not buy on the open retail exchanges like Coinbase or Kraken, where your limit orders are sitting. They buy over-the-counter directly from the miners or massive liquidity providers. Because of that, the billions of dollars flowing into Bitcoin, do not create the massive retail FOMO spikes you are used to. They create a slow, methodical, algorithmic grind upwards that completely prices out the average trader. And when they want to short the market, they now have massive derivative chains built on top of these ETFs to do so with perfect efficiency. They have essentially built a financial cage around Bitcoin, taming the wild beast and turning it into a compliant pet for the bond market. So, how exactly do you survive in a casino when the house suddenly decides to change the mathematical probability of winning? First, you need to completely erase the 4-year halving cycle from your memory. It is a relic of the past, a ghost story told by crypto influencers who need you to keep clicking their affiliate links to pay for their lifestyle. The new god of the cryptocurrency market is not the Bitcoin code. The new god is global macro liquidity. We are talking about the M2 money supply, the Federal Reserve's balance sheet, the Bank of Japan's yield curve control, and global sovereign debt issuance. Once upon a time, crypto existed in a vacuum every day. Its price was dictated by internal network metrics, hash ribbons, and retail sentiment on Twitter. But then one day, it became fully integrated into the global financial plumbing. Because of that, Bitcoin no longer moves when the block subsidy drops from 3.125 to 1.56. It moves when Jerome Powell decides to inject $1 trillion of shadow liquidity into the banking system to prevent a treasury market collapse. And because of that, you cannot trade crypto looking only at crypto charts anymore. You have to look at the global bond market. You have to watch the strength of the US dollar index. You have to monitor the reverse repo facility. The 4-year cycle has been replaced by the global macro liquidity cycle. And if you are not tracking the macro, you are flying blind into a Category 5 financial hurricane. Let me break this down so it is painfully clear. When central banks print money, that liquidity flows downhill. It starts at the top with sovereign bonds, flows into mega-cap tech stocks, spills over into Bitcoin, and then, only if there is absolute degenerate euphoria, does it trickle down into your low-cap altcoins. But in 2026, the macro environment is fundamentally broken. We have sticky inflation, massive geopolitical supply chain shifts, and a sovereign debt burden that is mathematically unpayable. Therefore, the central banks are trapped in a nightmare scenario. They have to print money to service the debt, but they cannot let inflation run to hot and destroy the currency. So they do this intricate dance of stealth liquidity. They pump the system just enough to keep the stock market at all-time highs and Bitcoin stable. But they intentionally starve the real economy. This creates a hyper-concentrated, K-shaped market. The top 1% of assets absorb 99% of the capital. This means the days of a rising tide lifting all crypto boats are over forever. In the old cycles, you could throw a dart at a list of random coins and make money because everything went up together. In a wave of zero interest rate euphoria, today, Bitcoin might hit $150,000, while your favorite metaverse or gaming token from 2021 bleeds out another 90% against Bitcoin. The altcoin market is experiencing a slow, agonizing death by 1,000 cuts. And it is all because the macro liquidity is being surgically targeted into institutional vehicles, not the retail casino. You are trapped in the psychological cycle of market grief. First, there was denial. You denied that the traditional bull market was over. Then came anger, when your favorite influencer's $100,000 predictions failed to materialize in the timeline you wanted. Then bargaining, telling yourself you will just hold and sell when your portfolio finally breaks even. And now, millions of retail investors are in the deep depression phase, watching the institutions pump the top-tier assets to new highs, while their personal portfolios are still down 60 to 80%. This brutal divergence is exactly what the death of the 4-year cycle looks like in real time. In the past, Bitcoin dominance would inevitably drop, and altcoins would fly to the moon. That was the sacred alt season everyone prays for. But you have to understand that historical alt seasons were fueled by retail euphoria and massive unregulated offshore leverage. Today, the global regulators have aggressively crushed the offshore casinos. The massive 100x leverage is gone. The retail euphoria is dead. crushed under the crushing weight of sticky inflation and the rising cost of living. The average person simply does not have $5,000 of disposable income to throw at a dog-themed meme coin anymore. They are struggling to pay their grocery bills, their energy costs, and their mortgage rates. Because of that, the fresh capital required to trigger a massive, broad market alt season simply does not exist. The only fresh capital left in the system is corporate capital, sovereign wealth capital, and pension fund capital. And let me tell you a secret. Corporate capital does not buy dog coins. It does not buy dead metaverse land. It buys infrastructure. It buys compliance. It buys yield. You have to understand that the game is not about picking the next 1,000x microcap gem anymore. That is a lottery ticket, and the odds are worse than they have ever been in the history of the asset class. The game right now, in 2026, is entirely about asset preservation and strategic allocation alongside the smart money. You need to position yourself in the base layer protocols that institutions are actually using to settle trillions of dollars of value. You need to understand the fundamental difference between a useless governance token that gives you the right to vote in a dead Discord channel and a protocol that actually captures real economic yield from institutional adoption. The four-year cycle did not just die, it evolved into a financial apex predator. It is a super cycle of global liquidity and tokenized real-world assets, commanded by advanced algorithms and Wall Street balance sheets. If you do not adapt your strategy today, if you keep stubbornly waiting for the ghost of 2021 to suddenly return and save your portfolio, you will be left holding bags of worthless digital tokens while the rest of the world moves on to the new financial operating system. Do not let Wall Street steal your wealth by using your outdated beliefs and historical chart patterns against you. Wake up, look at the macroeconomic data, follow the real institutional money, and stop trading like it is still the Wild West. The Wild West has been paved over, and a Goldman Sachs branch has been built directly on top of it. If this brutal reality check opened your eyes to what is actually happening behind the scenes, hit the like button right now, subscribe to the channel, and share this video with that one friend who is still holding a massive bag of dead altcoins, desperately waiting for a miracle. Do not let them become the institution's exit liquidity. And listen very closely, because you do not want to miss what is coming next on this channel. In the next video, I am going to completely expose the exact 3 real-world asset sectors that institutional giants like BlackRock and Fidelity are quietly accumulating right now, while everyone else is completely distracted by the noise and the fear. I am going to show you the on-chain footprints they are trying to hide from the public. Make sure you hit the bell icon, because you absolutely cannot afford to miss that one.